Ladies and gentlemen, Asian guy here, and I need you to sit down for this one because what I'm about to show you isn't just another market move, it's the smoking gun that proves everything they've been telling you about. Silver is a carefully constructed fiction. While you were checking your portfolio this morning, probably nursing a hangover from New Year's celebrations, something absolutely unprecedented happened in the precious metals market. Silver, which closed Friday at $82.40, opened Monday morning in absolute freefall. By 2:47 a.m. Eastern Time, the price had crashed to $73.72. That's a 10.5% nosedive in the dead of night during the thinnest trading week of the entire year. Now, if you're watching CNBC right now, they're telling you this was profit-taking. They're saying retail investors got spooked. They're painting a picture of nervous mom-and-pop traders panicking and hitting the sell button. I'm here to tell you that's complete garbage. Because while Wall Street was busy liquidating some overleveraged hedge fund at 2 in the morning, while the Federal Reserve was quietly injecting $34 billion into the repo market to prevent a systemic meltdown, and while every financial commentator was screaming about the silver bubble bursting, something fascinating was happening 7,000 miles away in Shanghai. The Shanghai Futures Exchange, where actual industrial buyers who need physical silver to manufacture solar panels and electronics trade, closed Monday at 20,073 yuan per kilogram. Let me do the math for you because this number is the entire story. That's $89.18 per ounce. Read that again. While New York was trading silver at $73, Shanghai was trading it at $89. That's a $16 premium, a 22% difference between the paper price in the West and the physical price in the East. That doesn't happen in a functioning market. That's not arbitrage opportunity. That's a broken system screaming at you that something is fundamentally wrong. Let me walk you through exactly what happened in the early hours of Monday morning, because understanding the mechanics of this crash is the only way to see why it's actually the most bullish thing that could have happened. At approximately 2 a.m. Eastern, somebody very large and very leveraged hit a wall. We're talking about a major institutional player, probably a hedge fund, possibly a prime brokerage client, who was holding a massive long position in silver futures contracts. And when I say massive, I mean tens of thousands of contracts, each representing 5,000 ounces. This whale had one critical problem. They were using leverage. They didn't own the silver outright. They were borrowing money to control a position far larger than their actual capital could support. And somewhere between Friday's close and Monday's open, their account breached what's called maintenance margin. In the retail world, when you breach maintenance margin, your broker sends you a friendly email asking you to deposit more funds. In the institutional world, there are no friendly emails. There's just an algorithm that wakes up and starts selling your position immediately, regardless of price, regardless of market conditions, regardless of anything except one single mandate: get this account back to solvency now. And here's where the timing becomes absolutely crucial. This liquidation didn't happen at 9:30 a.m. when the New York Stock Exchange opens. It didn't happen during London hours when European traders are active. It happened at 2 a.m. during what traders call Ghost Week, the period between Christmas and New Year's when every major institutional desk is on vacation. Think about who's actually trading silver at 2 in the morning on December 30th. The pension fund managers, they're in Aspen. The algorithmic trading desks, most of them are running skeleton crews. The retail investors, they're asleep. The order book at 2 a.m. during Ghost Week is essentially empty. The bid stack, that wall of buy orders that normally catches falling prices, is paper thin. There's maybe 1/10 the normal liquidity. So when this liquidation algorithm started firing sell orders into the market, there was nobody there to catch them. The first 1,000 contracts sold and the price dropped $1. The algorithm looked for more buyers at that level. There were none. So it dropped the price another $1, hunting for liquidity. This is what's called a liquidity cascade. The price doesn't fall because the asset became less valuable. It falls because there's a temporary vacuum of buyers. It's like trying to sell a house during a hurricane. The house didn't become worthless. There's just nobody around to buy it at that moment. The algorithm kept selling. $80, $78, $76, $74. It was hunting for buyers that simply didn't exist until it finally found a floor at $73.72. But here's where the crash went from bad to catastrophic. Because that initial liquidation triggered a secondary explosion that most people completely missed. You see, on the other side of all those futures contracts are banks, JP Morgan, Goldman Sachs, HSBC, who act as market makers. They don't necessarily want to be long or short silver. They just want to facilitate trades and collect fees. So they hedge their positions constantly using something called delta hedging. Without getting too technical, these banks were short puts, betting silver wouldn't fall below certain levels, and they were managing that risk using gamma exposure. When silver started crashing, their gamma flipped negative. Negative gamma means that for every dollar the price drops, the bank's hedging model mathematically requires them to sell more silver to stay balanced. It creates a doom loop. Price drops, bank sells to hedge, which pushes price lower, which forces more selling. This is why the crash was so violent. It wasn't just the whale liquidating, it was every major bank's risk management system simultaneously becoming a forced seller, chasing the price down into the void. Now, if this was just a normal market correction, the story would end there. Whale dies, price bottoms, market moves on. But that's not what happened. Because at approximately 3:15 a.m., right as silver was testing that $73 level, alarms started going off at the Federal Reserve's overnight operations desk. They were seeing stress signals in the repo market, the plumbing of the financial system, where banks lend cash to each other overnight. Here's what they were panicking about. When that whale blew up, they didn't just lose their own money. They owed billions to the clearinghouse, the entity that guarantees all futures trades. If the whale couldn't pay, and they couldn't because they were bankrupt, the clearinghouse was on the hook. And if the clearinghouse couldn't cover those losses, the entire futures market, not just silver, but oil, bonds, currencies, everything, would freeze. We're talking about a potential systemic failure. So the Fed did what it always does in a crisis. It printed money. Specifically, they injected $34 billion into the overnight repo market. This wasn't announced in a press release. There was no Jerome Powell speech. But if you know where to look, at the repo facility usage data, at the overnight swap lines between central banks, you can see the fingerprint. That $34 billion was essentially a bailout. It provided liquidity to the banks so they could absorb the whale's losses without collapsing themselves. It was a concrete floor under the market, a line in the sand that said, "We won't let it go lower than this," and that's why the price stopped falling at $73.72. Not because of technical support, not because buyers stepped in, because the Federal Reserve backstopped the entire paper silver market with an emergency injection. Think about the absurdity of that for a moment. The Fed had to deploy $34 billion, more than many countries' GDP, just to keep the silver futures market from imploding. That's not a sign of a healthy, stable market. That's a sign of a system built on leverage and derivatives that's one bad trade away from complete collapse. Now, here's where the story goes from interesting to mind-blowing. Because while all this chaos was unfolding in New York, while the Fed was frantically plugging holes with printed money, the Shanghai Futures Exchange was doing something completely different. They were trading silver like none of this mattered. The front-month Shanghai silver contract closed Monday at 20,073 yuan per kilogram. Let me break down this calculation step by step because it's the most important number you need to understand. 20,073 yuan divided by 7.04 exchange rate equals $2,851.56 per kilogram. $2,851.56 divided by 32.15 ounces per kilogram equals $88.71 per ounce. While New York stabilized around $75, Shanghai closed at $89. That's a $14 premium, nearly 19% higher. In a normal functioning market, this premium shouldn't exist for more than a few seconds. Arbitrage traders should instantly buy silver in New York at $75 and sell it in Shanghai at $89, pocketing the $14 difference. That arbitrage should close the gap immediately, but it's not closing. The gap is sitting there, widening, screaming at anyone who's paying attention. Why? Because the January 1st, 2025 Chinese export licensing requirements have created a firewall around Chinese silver. The metal that's in China stays in China. You can't just buy silver in New York and ship it to Shanghai anymore. You need government approval, which takes months and is increasingly being denied. This means we now effectively have two separate silver markets on planet Earth. The paper market, New York, dominated by hedge funds, algorithms, leverage, and derivatives. Price determined by whoever has the biggest computer and the most leverage, currently trading at $75 after a Fed bailout. The physical market, Shanghai, dominated by industrial manufacturers who need actual metal to build solar panels, electronics, and EVs. Price determined by real supply and demand, currently trading at $89 and rising. The gap between these two prices is the gap between fiction and reality, and it's widening. Want more proof that the physical market is completely disconnected from the paper market? Let me show you what happened at the COMEX vaults last Friday, right before this crash. According to the official COMEX warehouse report, 600,133 ounces of silver were physically withdrawn from registered inventory on Friday, December 27th. Gone, removed, taken into private possession. Total COMEX registered silver inventory is now sitting at 449,127,595 ounces. For context, that's down from over 500 million ounces earlier this year. Now think about the timing. Somebody withdrew 600,000 ounces, worth about $50 million, right before the crash. This wasn't some panicked retail investor. This was a sophisticated entity that saw the price, saw the shortage, and decided to convert their paper claims into physical metal while they still could. This is the behavior of someone who knows the paper price is fake. They're using this suppression to drain physical supply at a discount. It's the ultimate bank run, trading paper dollars for hard assets before the paper becomes worthless. And this isn't a one-time event. Comics inventories have been draining consistently for months. Every time there's a price dip, physical buyers back up the truck and take delivery. Meanwhile, open interest, the number of outstanding paper contracts, remains near record highs. We're talking about over 900 million ounces of paper claims against less than 450 million ounces of physical inventory. That's a 2-to-1 ratio of paper to physical, and it's getting worse. Now, let's address the narrative that the mainstream media is pushing hard right now. Turn on Bloomberg and you'll hear silver plunges as retail investors panic sell. This is gaslighting, pure and simple, and I have the data to prove it. Let's look at actual retail behavior during the crash. ETF flows, SLV, the largest silver ETF, actually saw net inflows on Monday. Retail investors were buying the dip, not selling it. Bullion dealer volume, sites like APMEX, JM Bullion, and SD Bullion reported traffic spikes of 300 to 400% on Monday. And 90% of that traffic was on the buy side. The premiums on physical silver coins and bars actually increased during the crash. Coin dealer reports, major dealers are reporting that they sold out of popular silver products within hours of the crash. American Silver Eagles, Canadian Maples, even junk silver bags, all cleared out. So if retail didn't sell, who dumped 5,000 contracts at 2 a.m.? We already know the answer. It was the forced liquidation of an overleveraged institutional whale. The selling came from a bankrupt hedge fund whose computer was programmed to liquidate at any price. It didn't come from the community of silver stackers who've been waiting years for this moment. So why is the media lying? Why push the retail panic narrative so aggressively? Because they need a scapegoat. They cannot admit that a major financial institution blew up. They cannot admit that the clearinghouse almost failed and needed a $34 billion bailout. If they told the truth, that the paper silver market is fragile and nearly collapsed from a single margin call, it would trigger an actual panic. So instead, they blame you. They want you to doubt yourself, to think you're the dumb money, so you'll sell your position in fear. It's a psychological operation designed to shake out weak hands. But the data is clear. The retail investor was the smart money on Monday. You were buying what Shanghai values at $89 while the pros were being liquidated at $73. Which brings us to the most important question. What happens next? We're currently in a very unique situation. The forced seller is gone, liquidated, bankrupt, out of the market. The leverage has been flushed from the system. The Fed has backstopped the paper market with $34 billion, ensuring no more clearinghouse failures. And we're about to hit January 2nd, the day when every institutional trading desk returns from vacation. Think about what these traders are going to see when they log in Thursday morning. 1. Silver crashed 10.5% in the thinnest liquidity of the year. 2. The Shanghai premium has blown out to $14 to $16. 3. Comex inventories continue draining, down 600,000 ounces last week alone. 4. Physical premiums spiked during the crash. Bullish signal. 5. ETF inflows were positive. Retail bought the dip. 6. The Fed intervened with $34 billion, confirming systemic importance. Every single one of these signals points to the same conclusion. The crash was a liquidity event, not a change in fundamentals. And here's what's going to happen when institutional capital returns. They're going to buy this dip aggressively. Pension funds with mandates to allocate to commodities in Q1. Sovereign wealth funds seeing the Shanghai premium as an arbitrage opportunity. Algorithmic trend-following systems that will flip long once price breaks back above $80. We're not looking at a slow grinding recovery. We're looking at a snapback, a violent move back to the upside as the liquidity vacuum gets filled by a tsunami of institutional buying. Let me give you specific levels to watch over the next 48 to 72 hours. Immediate resistance, $79 to $80. This is where the crash began on Friday evening. A break back above this level confirms the liquidation is over and signals a return to the bull trend. First target, $85 to $87. This would represent a full recovery to pre-crash levels and would likely coincide with headlines about silver's resilience and institutions buying the dip. Second target, $92 to $95. This is where we start to see FOMO kick in. At this level, we're above the previous all-time high, and momentum traders start piling in. The Shanghai convergence, $105 to $110. This is the level where the paper price finally catches up to physical reality. If the Shanghai premium remains at $14 to $16, and if Western prices move to converge with Eastern prices, we're looking at triple digits within weeks. But here's the key insight that most people miss. The crash actually makes the upside targets more likely, not less. Why? Because the weak hands are gone. The overleveraged speculators who would have been forced sellers at $95 or $100 are already out, liquidated at $73. The market structure is now cleaner. The remaining holders are true believers, physical buyers, and institutions with longer time horizons. The slingshot has been pulled back, and on January 2nd, someone's going to let go. Step back from the hourly charts for a moment and look at what's really happening here. This isn't just about one commodity having a volatile week. This is about a 50-year monetary system reaching its breaking point. Since 1971, when Nixon closed the gold window, the entire global financial system has been based on pure fiat currency. Money backed by nothing but government promises and central bank printing presses. For decades, that system worked because everyone agreed to play along. But something has changed in the last few years. The trust is breaking down. We've seen central banks buying gold at the fastest pace since 1967. BRICS nations openly discussing alternatives to the dollar. China stockpiling strategic commodities, including silver. Industrial demand for silver hitting all-time highs. Solar, EVs, 5G. Mine production remaining flat despite soaring prices. Paper markets requiring bailouts while physical premiums explode. Every one of these trends points to the same conclusion. We're watching the slow-motion collapse of the paper monetary system and the return to hard assets. Silver sits at the intersection of this monetary shift and an industrial supply crisis. It's both a precious metal and an industrial commodity. That dual nature makes it possibly the most mispriced asset on the planet. The $73 crash wasn't the end of the silver bull market. It was the shakeout before the real move begins, the move that takes us from silver is expensive to silver is unavailable. If you sold your silver during the crash, I'm not here to make you feel bad. Volatility is terrifying, and 10% drops at 2 a.m. would shake anyone's confidence. But if you held through it, or if you bought the dip, understand what you just did. You traded paper currency that required a $34 billion bailout to function for a hard asset that Shanghai industrialists are paying $89 to secure. The next 30 days are going to be critical. We're heading into a period where industrial buyers return from holidays and resume purchasing. Investment funds rebalance portfolios for the first quarter. Chinese manufacturers pre-buy ahead of Lunar New Year shutdowns. The gap between paper and physical becomes impossible to ignore. The system is trying to tell you something through that $14 Shanghai premium. It's trying to tell you that the paper price is fiction and the physical shortage is real. When you see the headlines about silver's volatility or retail panic, remember what actually happened. An overleveraged hedge fund died. The Fed had to intervene with $34 billion, and physical buyers used the chaos to drain another 600,000 ounces from the COMEX vaults. The crash was the last desperate attempt to shake you out of your position before the real shortage hits. The question is, did it work? Because while Wall Street was busy liquidating paper contracts at 2 in the morning, Shanghai was open for business, paying $89 per ounce for physical metal. And that premium is telling you everything you need to know about where this is headed next. The $34 billion emergency injection didn't fix the shortage. It just bought the paper market a few more weeks before the physical reality destroys the fiction completely. And when that happens, the crash to $73 is going to look like the bargain of the century. Asian guy here, signing off. Don't let them shake you out. The game is just getting started.